So welcome and thanks for coming. It's wonderful to see so many clients here today, and it's wonderful also to see so many guests. So for the guests who are coming for the first time, thanks for your attendance. For those who don't know me, my name's Paul Nicol. I'm the Managing Partner of GFM and I'm your MC for today. I'm one of 5 advisors in the firm. Our other advisors is here. And while we're at it, I wouldn't mind acknowledging the whole GFM team that are in attendance. An event like this isn't easy to run and easy to organise, and as usual, particularly May's done a superb job to make sure that today runs very well. I think everybody understands that GFM has a long history of running these what we call educational events or seminars. We've done so for many years, and at the core of our DNA is that we like to make sure that our clients are as informed as possible. And the way we do that is we do our very best to get quality presenters that will provide quality information in a very timely manner. And I must say, today I'm particularly excited about the event we have. In my humble opinion, I think we've put together what I will call a rock star panel of some of the very best portfolio managers here in Australia. They're going to help us unravel the complexities of what's happening both in global and the domestic market. I'll formally introduce each of our presenters in a moment. But before I do so, just some housekeeping. There are notepads and pens in front of you. We usually print out the slides. We haven't done that today because this is mainly going to be a Q&A session. There will be some slides that will be up there, but we didn't print them out for you because, as I said, it's mainly a Q&A session. We're also going to provide an online feedback form after today's seminar, so we'd really appreciate if you could take the time. It'll be emailed to you. We'd really appreciate if you could take the time to complete that online form when it's sent to you later this afternoon. Make sure your mobile phones are off. Nothing worse than it ringing during the seminar, or on silent if you don't mind. If you do need to use the ladies or gents, they're back out near the entrance where you come in, and we are aiming to finish at around 2 o'clock. There's no doubt we've seen a high degree of market volatility during 2022. The world is grappling with rapidly rising interest rates, high inflation, the risks of a recession, and of course we seem to be in a period of escalated geopolitical tensions. It's a great thrill to have on stage, starting closest to Patrick, Mary Manning from Alphinity Investments. We've got Jack Colopy from Perpetual, and we've got Nick Griffin from Munro Partners. This is an expert panel. We are so fortunate to have the calibre of managers here today to unravel some of these complexities and help us make sense of it all. I'm also joined on stage by Patrick Malcolm. I think most in the room know Patrick. Patrick's a senior partner at GFM. The way today's going to work is both Patrick and I are going to ask questions of Mary, Jack and Nick. We're going to start with each of them just giving a quick 5-minute explanation of who they are and what they do, a quick intro. We'll then fire away with the questions. We're not going to take questions during the session that Patrick and I are facilitating, but towards the end of today's seminar, we're certainly going to open it up to the floor and we'll have roving mics come through. So with no further ado, I'll hand over to you, Patrick, to help introduce each of our panel members.
Thank you, Paul. So before we get started, particularly because our event today is recorded, we're going to show everyone our very exciting disclaimer that everyone needs to read at their leisure. But anyway, we'll get on to things. So, Mary, thank you for joining us today.
Thank you so much for having me.
Thank you for coming down from Sydney this morning. Is the weather any better up there than it is
No, it's
here?
Absolutely torrential, so I'm really happy to be here on a beautiful sunny day.
Beautiful. Thank you. Can you tell us a little bit about your background and the fund that you manage?
Absolutely. Thank you so much for having me, and thank you all for coming today. My name is Mary Manning. I'm a portfolio manager at Alphinity Investment Management, and there I'm a portfolio manager of the Global Fund and the Global Sustainable Fund. For my career, I'm originally from Canada, and I have an MBA and a PhD in economics, and I spent a lot of my career investing in Asia, emerging markets, and in global equities. And I'm really excited to be here today to talk about what's going on in the world, because it's a very interesting times.
a little bit about Affinity as well. Alfinity, Mary, sorry.
So Alfinity has about 17 billion funds under management. We're a boutique investment manager, and there's a couple key things that make Alfinity different from our competitors. One is we are not growth fund and not a value fund. Our process is based on following earnings leadership. So that means following stocks and investing in stocks that are in an earnings beat and raise cycle and where there's a clear earnings leadership. The second thing is we are a co-PM model, so the funds that I manage with 3 or 4 other people. It's quite a different model. It's a consensus-based decision making, and we think that leads to better outcomes for the funds and also for the clients. The third thing is that we always run diversified portfolios, so this is not a bet the farm strategy. We think this is a big macro outcome or this is a big stock outcome. It's always a diversified portfolio, and we think that that diversification along with the style agnostic approach and the co-PM model also leads to better outcomes for our clients over time.
Thank you, Mary. Jack, now you've come down from Sydney as well, which we greatly appreciate. I must say, I was watching your body language when the comment about the rock star fund managers came out. You seem the most uneasy.
Yeah, same.
But you do have the rock star fund, the microcap fund. So please tell us a little bit about your back.
That'll probably be the kiss of death.
No.
So my name's Jack Colopy. I work at Perpetual Investments. I've been there for 21 years. I run the small cap fund and the micro cap fund. Our investment, we're a value style of investing. We sort of have 4 basic quality filters that we invest by, businesses with good management, recurring earnings, quality businesses, and a good balance sheet. So look, a lot of that process is really built around capital preservation. So we're looking for good companies at reasonable prices, with good balance sheets, businesses we can understand. So most of you probably have heard of Perpetual, Australian listed fund manager, potentially doing a merger with Pendal at the moment. But the Aussie equity business is one I've been a part of for a long time and has a great heritage.
How long have you been managing the microcap fund for, Jack?
I started the microcap fund probably 8.5 years ago. So I run the small cap fund for 12. We saw some opportunities to invest in some smaller stocks that met our quality criteria, but the small cap fund was a little bit big, so we couldn't quite get set in them. So we decided to start a micro cap fund, and that's where we've become.
Thank you, Jack. Thanks for coming along today, Nick. You haven't come from Sydney, but I'm going to still thank you for coming along. I think you've just come from down the road like Paul. So, but thanks for joining us nonetheless. Now, I've got the Collingwood and Sydney supporters down the end here. I don't know how we managed that after the preliminary final. 1 point. So anyway, we'll get on to the important things. Can you tell us a little bit about your background, Nick?
Yeah, so my name's Nick Griffin. I'm the CIO and one of the founding partners of Munro Partners. Munro Partners is a Melbourne-based global growth manager. So our goal is you could probably call us the glass half full guys. Our goal is to be in your portfolio, to be global equities and to be growth. And so what we mean by growth is we're trying to find the next big thing that comes along. So our view is that our job is, you can look at global equities like being over or underweight certain sectors in certain countries. We think that's a useful way of doing it, but ultimately a bit of a waste of time. The reality is owning global equities is about finding the world's great growth companies, ones that can grow sustainably over a long period of time. And that sustainable growth normally comes from great structural trends. So the structural trends that we follow and the stuff we can talk about quite well is, anything around technology, whether it's digital payments or internet disruption or high performance semiconductors. We spend a lot of time looking at healthcare. We spend a lot of time looking at things like decarbonisation, which we think is a big structural trend that's occurring in the world, electric vehicles and everything within that. And we spend a lot of time looking at great emerging consumer companies, companies that we think are emerging in a consumer space. That's what we do, and we identify these companies generally a little bit earlier than most people do, and we try to run them from long periods of time. We run 3 funds at Munro that some of you may or may not be aware of. But the first is the Munro Global Growth Fund, which is our absolute return global growth fund. So it's a little bit different than most growth funds in the market. It's growth equities, but with discipline, with downside protection, with absolute return. And people like that product because of, quite frankly, what we've been going through a bit this year about focusing on capital preservation rather than just all in with these great ideas. Second product is a long-only product. And the third product is one we launched a year ago, which is a decarbonisation product, a product that's focusing on the enablers of decarbonisation globally. It's very much a thematic product. The last thing I'd just say about Munro is all 3 of our products are actually quoted on the Australian Stock Exchange. We're very happy with some of the codes we managed to get. The Munro Global Growth Fund is called MATE, M-A-E-T, MCGG for the long only, and MCCL for the Climate Fund. And those are our three strategies, and that's where we fit in your portfolio.
Thanks, Nick. We've stuck you between the Swan supporter and a value manager, so we haven't really looked after you. But over to you, Paul, for the first question.
Hey, we're all good friends.
Yeah, we are. So, Mary, I'll start with you. Obviously, we're all investors in the room. We know since the start of the year that markets have fallen in value. We've seen quite a considerable fall in the value of markets. Is this, in your view, because of the higher interest rate environment? And if you do feel that's the case, do we also then suspect this higher interest rate environment is going to have an impact on company earnings?
Yeah, it's a great question to start off, Paul. So if you look at what's happened to the MSCI World, which is the benchmark that our funds track for the global funds, it's down about 28, 29% year to date. And if you look at the contraction in the multiple, it's also around that much. So year to date, even though markets have done very badly, a lot of that has just come from stocks getting cheaper and the multiples contracting. So what we're looking at going forward is, when is the earnings shoe going to drop? Because a lot of companies have continued to post okay earnings and their stocks have gone down because the multiples contracted, not because there's been a huge earnings miss. So going forward, what we're watching very closely is for whether there's going to be a recession in the US, and some of these top line things are going to come through. So far, a lot of the companies that have missed earnings, they've missed it because you've had inflation and they haven't been able to pass through those costs, or they've missed earnings because the supply chain, as we all know globally since COVID, has been a complete mess. It doesn't matter whether it's grain or semiconductors or everything in between. And so you've seen companies miss earnings because of those sort of factors, but you haven't seen a big sort of recessionary rollover where the big consumer companies and the big technology companies are saying the world is a worse place, our revenues are going to be growing less than they have before. So that's what we're watching very closely right now. As I mentioned at the beginning, Alphinity follows earnings leadership, so we always want to be invested in companies where they're getting earnings upgrades. And for the last 9 months, it's been harder to find those kind of companies. But going forward, we're looking for companies that have that pricing power, companies that are in very good structural trend, so that they can continue to meet those earnings, even if there's a recession in the US, in the world, and even if supply chains remain challenged.
Patrick, can I ask Jack, from a domestic perspective, do you feel like we're going to see earnings roll over now as well?
Look, we've just finished reporting season. We've met with up to 100 companies through sort of August and into September. Backward looking, the profits were pretty good, if not come in slightly ahead of expected. But the market really is forward looking, and that's why you've seen those share prices come off. Market's always 6 months to 12 months ahead, and reflecting that in share prices. Yeah, there was a lot of uncertainty with management. I mean, the biggest risk really is that inflation remains stubbornly high. The cost line is obviously going up with inflation for a lot of these companies. Like Mary said, logistics, distribution, energy costs, wage inflation, just getting people is becoming challenging, as you would know, just through your experiences, on the ground. So there's a lot of uncertainty, and there's sort of no doubt that the cost line is increasing. How much and for how long, I guess, is the biggest question. The biggest risk, as I said, is inflation remains stubbornly high, and then further interest rates are required and will have some impact on the economy. Although they've raised very quickly, the RBA sort of up to 2.5% in 6 months or so, some of the effects of those rate rises probably won't be seen until December, as some people's fixed portion of their mortgages rolls over. So far, the consumer is still acting quite confidently, and that's because everyone has a job. There's plenty of jobs around currently, but as those profits start to get squeezed through those higher costs, we think that potentially employment might peak and roll off. So yeah, that inflation question is the biggest one.
Paul? Right.
Nick, just to pick up on a couple of comments there, particularly from Mary, I'm going to challenge your glass half full feeling, but you've been quoted recently as saying that you're a little bit concerned that the full economic impact of rate rises hasn't come through yet and hasn't flowed through the earnings and therefore to the market. Can you talk us through how far you think we're through that process?
Yeah, so I suppose for the audience, it's probably quite helpful here if you just take a step back and try and think about how you ended up in this situation. And we all remember how it happened. Basically, COVID came along 2-3 years ago. We dropped interest rates to zero and we handed out a lot of stimulus, right? And in the end, that created a boom. And a boom that it probably didn't feel like much of a boom for you, but it was a boom. It was a boom in e-commerce spending. It was a boom in retail spending. It was a boom in the property market. It was a boom in the equity market. And in the end, all of that became inflationary, right? And so what Mary and Jack were talking about is ultimately this inflation has come back. And we haven't seen inflation like this for decades. And so what central banks have to do now is they have to forget about everything else and kill inflation. They just have to kill it. And the only way they're going to kill it is with this really big blunt stick called interest rates. And so what they've done is they've taken interest rates from 0 to 3% here in Australia and nearly 4% in the US in the space of less than 12 months, okay? So inevitably that's going to have an effect. You know, people are going to spend less money. And to make this even worse, we're all still spending the money that we wanted to spend coming out of COVID, right? So it doesn't feel like much of a recession when it's $1,600 to get a ticket to Sydney and $20,000 to get to Europe, right? This is the reopening effect. And so these two things are going to come together, unfortunately, at the same time, which is that interest rates are high, and we've all probably spent a little bit too much money this year. I know I personally can't physically spend more money than I spent this year. I've got a huge backlog of holidays you just got to get through. And so from that point of view, you're going to get a slowdown, and you're going to get quite a big one. And you're going to see that in earnings, and that hasn't hit yet. The good news is the market's tried to price that in, right? So this is why the market is weak. It's trying to look forward, as Jack said. It's trying to price in how big that earnings downgrades are going to be. And the reason why it's so volatile is because we don't really know yet. We're sort of on the precipice of this. So from my point of view, I'd agree with both the comments. We are coming to a slowdown. It's because inflation came back. And I think for everyone in the room, you just got to take a step back and think, how long is it going to take to unwind this process of the 2 years prior to this? And it's probably a little bit naive to think it's all just going to unwind in the space of 6 or 9 months. It's going to take a bit longer than that. But the equity market's going to try and price it in much quicker than that. And that's what we're going through right now.
Is the Fed's job harder than the RBA's due to the structure of mortgages in the US, where most people are on 30-year fixed rate loans, whereas here most people are on variable rates?
Yeah, so to me, yeah. So the Fed's job is definitely harder because their inflation is stickier. And their inflation has got much bigger. So the Fed's job is definitely harder on that point of view. Secondly, politically, you know, they're under a lot of pressure to tame inflation. Here in Australia, you know, we have positive immigration. I'll let the other guys talk about this. We have positive immigration, and the RBA is already backing off the rate hikes, thinking that they might have done too much. But everybody in this room knows that there's a lagging effect of interest rates, right? We know this from '94. We know this from all these different periods, and we've just done all these big hikes, and so now we just have to work out what the lag is and how bad it's going to be. And that's just uncertainty, and that's the uncertainty the market's trying to price in. But without doubt, the US has a bigger problem than Australia.
I was 10 back in '94, Jack. So I struggle a little bit to remember that.
I studied it in
we might have to have a chat afterwards.
But yeah, 94 or 2005, it's always the same. And we're just at that point. And it's a little bit difficult, but yeah, the US problem is worse than Australia's.
Paul, you were 19 then, so can you...
Yeah, I was. Thank you, Patrick.
Well, not everyone in this room.
Yeah. So, Jack, while we're on this topic, so, you know, and Nick did touch on it a little bit, but domestically, so not only what you're hearing from companies here in Australia, but a house view of Perpetual, what's your feelings with the interest rate trajectory and how successful this trajectory so far is with the inflation problem we have?
Yeah, I mean, it's hard to know exactly, but they will continue to be aggressive. You saw them not raised by as much the RBA more recently, just to see that lag effect, as Nick mentioned, because everyone's spending habits are kind of still where they were, you know, in COVID, house prices high, money being handed out for free. So I think it's a bit of a wait and see. I mean, hopefully, you know, it's a shame if the interest rates go up, but it's a lot better than having hyperinflation sustained.
Yep.
So it's a necessary evil, but we'll certainly wait and see. I mean, at Perpetual, we kind of focus on companies with good balance sheets, so, you know, higher interest rates should affect them a little bit less, and companies that can pay sustainable dividends. So although the share prices can get knocked around a bit, we think, you know, can still eke out a good income from those companies.
Terrific.
Got a slide here on inflation. Question, sorry to keep going back to inflation, Nick, and sorry to keep picking on you as well. I wish we could have invested in inflation because the chart's absolutely off the roof. But where do you think we are with inflation, and how much longer do you think it's going to continue for?
So from our point of view, you don't really need to worry too much about inflation anymore because the central banks are determined to kill it. What you should be worried about is how much damage they have to do to kill inflation. And I think that's what we're talking about with earnings. So from our point of view, every month it stays around a little bit longer, and you're probably reading in the press, we had a bad inflation print just last week. We had one the month before that. The longer it hangs around, the higher rates have to stay for longer, and the worse the earnings slowdown is going to be. I agree with Jack. They're doing the right thing here. You have to kill it. The boom that all of us have enjoyed for the last 20 years is built on anchored inflation expectations. Those anchoring of inflation expectations from the 70s have actually facilitated the boom that we've all lived through. Now it's back, and so let's kill it as quickly as possible, and I think they will. I think we are close to that rolling over. You've already seen commodity prices roll over. You've already seen used car price roll over. There's someone at the Munro office who double-ordered Land Cruisers. He's got 2 Land Cruisers, so if anyone wants to have one, there's been a lot of double ordering going on. Does that make sense? And so people have double-ordered clothes. Retailers have ordered all this inventory. They're going to have to mark it down. So anecdotally, you can see that inflation is not really going to be the long-term problem anymore, and we're going to kill it. It's just what we're trying to work out as investors is, back to your earnings point, is how much damage we're going to do along the way.
So there is this narrative around it being longer term rather than shorter term. You're not worried about inflation being higher for longer?
I think as long as the central banks stay the course here, and we really want them to stay the course. So the last thing you want them to do is to back off too soon here. We'll be really clear about this, okay? I know this is a little bit painful, but this is a good pain. It's a pain we deserve. We all gorged at the fountain a bit too much in the last 10 years. And so as long as they don't back off too soon, inflation will go away quickly. Because as we all know, a lot of it was, transient things. I think the stupidity that we all, also the naivety that we all had, was to think that there's any such thing as transient inflation, because there is no such thing as transient inflation. Once it arrives, people ask for more money, and it becomes ingrained. My great anecdote, and I'm sorry, I know I'm talking a bit here, so make sure you shut me up.
No, not at all.
But I was in my travels this year. I went to Edinburgh, and I was in Edinburgh during the festival, and the festival's on. Have any of you been to Edinburgh and the festival? It's a great place. And Munro is mountains in Scotland, by the way, if you want to read the history. And the Garbos had gone on strike for the whole month of April, for the whole month of August. They'd gone on strike, and the whole city was just filling up with rubbish. And they went on strike literally for the whole month. And why? Because they wanted a 10% pay rise. And the government didn't want to give them a 10% pay rise because 10% is a lot. And they said, well, inflation's 10%. So I deserve a 10% pay rise, and the rubbish is just going to keep piling up till you give me the money. And you sort of feel for them. They deserve a 10% pay rise. Energy prices are high in the UK. So from that point of view, this is why you have to kill inflation quickly. I think they will kill it. We are getting close to inflation rolling over. I don't think that's really the problem anymore. The problem is how much damage you're going to do to kill it. Every month it stays around longer, the more damage you're going to have to do.
Okay, so Mary, inflation, we've covered it. It's at the forefront of everybody's mind. As a very experienced portfolio manager now, when looking at investing clients' funds, are there certain sectors of the market that you're wary of in an inflationary and high interest rate environment? And in fact, the other way, does that potentially open up opportunities for certain sectors, or are there sectors that look more appealing in this inflationary environment?
Yeah, so I'll say 2 things. The first thing is a lot of our conversation has centered around the US and then Australia. But there are actually a lot of other countries and a lot of other dynamics going on in the world that have slightly different trajectories. So as a global fund manager, finding those countries or those companies that are exposed to those different trajectories is really important. So I'll give you a few examples. One is, even though there is high inflation in Europe, Europe also has this Russia-Ukraine situation, and it's very, very complicated in terms of what that is going to do to the environment overall. So we have relatively less exposure to European companies because that's a concern within Europe. The UK, I'm not going to spend any time on the UK because it's a complete disaster. So sort of to some things that Nick was mentioning, I think that the risk of policy mistake is very, very high right now, extremely high. I wouldn't want to be a central banker or a finance minister. Yes, because our friend in the UK who lasted for 5 weeks and is the second shortest chancellor, ever in the history of the UK, the chance of policy mistake is very high. So finding countries that you can invest in where that policy, or the probability of policy mistake is lower, is a way that you can generate good alpha for your clients and find good investments. So one example there, and I guess the last thing to mention, I think we'll talk about it a little bit later on, is that China is on a completely different trajectory than the rest of the world. All the things Nick was talking about coming out of COVID and people spending a lot and a lot of travel, China is like in 2020. They are 2 years behind everywhere else in the world. So I've been investing in global markets for almost 25 years, and I can never remember a time where there's been this much difference between where certain countries are heading and where other countries are heading. So that's complicated, but that's also a good opportunity from an investment perspective because you can find some really interesting opportunities. So for us, we still do like a lot of the US companies, less focused on Europe, zero in the UK, and looking at China, but it's still too early. And then there are some other countries, Brazil is a good example. Nobody cares about Brazil, but Brazil actually is probably a year ahead of the rest of the world in terms of they've already raised interest rates by over 1,000%. Inflation has peaked, unemployment has peaked. So we don't have a lot of exposure there, but it's just a good test case for how the rest of the world could turn out. Then in terms of stock specifics and sectors, by far, the number one thing that we are looking for at companies right now is companies that can pass through costs. Because if you are, so I'll give you an example of, it's the biggest stock in our global core fund, which is LVMH. So LVMH, as you all know, is Louis Vuitton and a number of other luxury brands, and their end consumers are very price insensitive, and they have a very specific supply chain that is based primarily in Europe. So if prices of their goods go up, they just increase the Louis Vuitton handbag from $7,000 to $7,500, and the end consumer doesn't care. So you have seen that those kind of, like luxury has been a very strong performing sector this year, and that's just one example. But in general, whether that's waste companies in the US or whether that's industrial companies that have pricing power, we're just looking for those kind of stocks that can and pass things through. And then to your question, Paul, the flip side of that is you don't want to be invested in companies that can't pass through inflationary costs, because all that happens is their margins get crunched, and even if they can maintain that top line growth, their margins get crunched, their earnings get crunched, and the stock goes way down. So that's sort of, investing in companies that have pricing power and avoiding ones that don't is a big thematic running through our portfolio right now.
Can I also ask Nick, as a global manager, you share similar views to that, Nick, in terms of the earnings in this inflationary environment, sectors or industries that you potentially feel can potentially, well, not benefit from the inflationary environment, but certainly protect themselves from the inflationary environment versus certain other sectors of the market that look more at risk?
Yeah, I mean, I'd agree with Mary. I mean, we have a fairly simple investment philosophy. Companies that make more money every year, we generally think their share prices go up. That's not meant to be complicated. In this environment, you're looking for companies that can upgrade earnings, usually from some big structural tailwind. Those structural tailwinds are still out there, but it's a more difficult environment. So from our point of view, definitely investing in more resilient companies, but also important, and also investing in companies that we think can upgrade, and clearly the energy transition's a good spot to put there, and we can talk about that. The other thing we can do, obviously, is as I mentioned before, our first product is an absolute return product. So we actually have the ability to short sell. Short selling is making money out of stocks going down. It's a bit like your left foot. You kick better with your right, i.e. stocks going up is much easier to do, but sometimes it's handy to be able to kick with your left. This has been a good year to kick with your left. Finding stocks that have earnings downgrades is actually easier than companies that have earnings upgrades. And so we've been adding performance through the second and the third quarter through short selling. And it's something we might do for about another quarter before this market roughly bottoms, and then we can go back to kicking with our right foot. But that's one of the other tools that we have out there, to focus on those earnings downgrades that inevitably are coming.
Yeah, brilliant.
Jack, we're going to steer away a bit from inflation. I'm going to say pivot away from inflation. When you're talking to the companies that you do on a day-to-day basis, what are they worried about in addition to rising costs?
Well, and also they're not worried about the cost rising, they're worried about the revenue coming off. People are trying to pass on price. As Mary said, that's critical to invest in businesses that can, but a lot of companies can't, and we've seen some companies today, I think Adelaide Brighton had a downgrade today. They needed to put up prices to offset the rising costs, but the price rise didn't stick. So that resulted in significant downgrade. The stock's down 20% today. And I just note that we had that inability to put prices through. So companies were worried about then the top line in that inflationary environment. I mean, some very good companies can pass on costs, but a lot can't. So once again, you've got those negative jaws where the revenue's going down, costs going up. So those margins are very much under pressure. So I think that's probably the follow-on effect from inflation, though, but yeah, affecting the top line and price rises.
I know we've got 3 active managers here, but passive has sort of fared really, really well over the last 20 years because of these tailwinds of lower interest rates and strong share markets. But what a time to be an active investor rather than a passive investor because of all this volatility.
For me?
Yeah.
Yeah, no, it is. Yep. I mean, like I said, with the absolute return fund is allowed to hold cash. We raised 40% cash in January. The simple story I like to tell people is sometimes you play cricket and you win, sometimes you play cricket and you lose, and sometimes it's just raining. And you have to just recognise, I know this is getting horribly bearish, and trust me, we're not that bearish, but sometimes it's just raining, and it's been raining a bit this year, and so why not hold more cash? Having the ability to short sell is very helpful, and then having that cash available to pick up what I think is going to be some generationally great buying opportunities, I think is really exciting. So it's nice to have a flexible mandate in this environment, and one that we're enjoying using.
Mary, to pick up on that, we all talk about how tough it is at the moment, but does it make you excited to look at the opportunities that you've got in front of you at the moment?
Yeah, absolutely. So I cover internet sectors and I cover consumer discretionary are two of the sectors that I focus on. And if you look at all the internet companies in MSCI World and you sort them by their year-to-date performance, there's some really good companies that are down 70-80% year-to-date. And so there's a lot of opportunities, I think, with that long-term trajectory that are coming through. And, at the end of 2021, from a valuation perspective, any investor who's a disciplined investor just could not touch these companies because the valuations were just extreme. And now those have all come down. So some of these stocks, particularly in the US internet sector, they're not in an earnings upgrade cycle yet. So I'm not getting ready to buy them. But we have something called the best research ideas list. It's where you put the ideas that you're excited about. And my BRI, that's our nickname for it, is like growing every day because there are some really exciting opportunities coming through, particularly in I'd say US tech.
I wouldn't mind coming back to that conversation about China, if that's okay. I think China largely feels like a little bit of an elephant in the room. So it's going to be a question for you to start with, Mary, but then I'd love to get you involved as well. So, Mary, you've obviously got a very deep knowledge of investing in Asia and investing in China. Can you you did mention about how it feels like it's 2020 in China, but can you paint the landscape as to what's happening in China at the moment and your view of being an investor in Chinese stocks?
Yeah. Okay, so I'll paint the view. Obviously, COVID started in China, and China, both the economy and the market started to come off quite sharply in 2020. But that was not the only thing that's going on in China. I think for me, and as Paul said, I have invested in Asia for over 20 years. The difficult thing about China right now is that there's a lot going on. So first of all, you had COVID, and there doesn't seem to be any specific pathway out of COVID. Then you had, starting in 2020, actually a little bit earlier than that, with the cancellation of the Ant IPO. Ant is like the biggest financial sort of product within the Alibaba group. There was very extreme pressure on a lot of the big Chinese tech companies because of regulatory reform, and they're still not really out of the woods there. Then on China, you had the property market starting to crack, and not unlike markets like Australia or Canada and the US, the property market is a very big source of wealth in China. So when that starts to roll over and you have some of the big developers going bankrupt and a lot of risk there, that's another sort of layer of the cake. And I guess the last thing is just politically and geopolitically, you have President Xi, the Chinese Party Congress meetings are going on as we speak, and he is going to be in for a third term, which is, sort of unprecedented or certainly not a regular occurrence in China. And then you have all the geopolitical stuff with respect to Hong Kong and China. So there's a lot to wade through with China. Other times in my career where there's been issues with China, it's like it was either SARS or it was geopolitical things, or it was, problems with the SOEs. But I can't remember a time where it's been all these things. So how to look at it going forward? I have sort of a checklist in my mind. We are not directly invested in China right now. We do have indirect exposure via like big US consumer companies, but no direct exposure in China. So to take a direct exposure in China, I'd want to see a couple things. One is a pathway out of COVID, and that even if it takes 6 months or 9 months, there needs to be something like when vaccination rates are here, or when the economy is here, or there needs to be some sort of pathway out of COVID. The second thing is some sort of comfort that the regulatory crackdown on the big Chinese tech companies, which in my opinion are some of the best companies that are going to come out of China ever, that regulatory crackdown is in its final stages. The third thing is to see some sort of stability in the macroeconomy. So when I first started investing in China over 15, 20 years ago, it was double-digit GDP growth. And then it sort of rebased to around 8%, and then it rebased to 6%. And then the goal is to grow at 5%, but its quarterly growth is coming in at like 2.5%, 3%. So for China to be growing at 2.5%, 3% is very, that's a very significant deceleration. So I'd like to see that growth trajectory is bottoming and that growth is going to start to pick up. And then lastly, Nick alluded to it a bit before with respect to inflation. You do have a US political cycle that's going on right now, and a lot of this attention on China, the technology and the semiconductors, a lot of that is based on the US political cycle. So once we're through the midterm elections, and I think some of that heat will come off China, there's some, to your question before, there's some really, really exciting, well-valued, excitingly valued companies there, but I need to go through quite a few things on my checklist before I'd be comfortable investing directly.
I'll come to you, Nick, but Mary, we've seen the valuation, particularly some of these, you call them world-class Chinese internet businesses, the prices of those companies have come off substantially.
Yeah.
So even despite the significant devaluation, in your mind, that checklist, you need to get the tick in the box for all of those. Like, how cheap can it get where you feel that it's so cheap you've got to invest?
Yeah, just close your eyes and invest. So some people say that just close your eyes and invest in China, but investing with your eyes closed is not a good strategy. So I guess going back to what I mentioned at the beginning, Alphinity looks for stocks that are in an earnings upgrade cycle. And to tie in with the macro point, a lot of these stocks, you can love them. You can love the brand name, you can love the thematic, you can love all the things, but the truth is they're still getting earnings downgrades. And so that's, I guess, the first thing on my checklist is to look at at a company specific level, these stocks are back into earnings upgrade cycle. So like the Tencent, Alibaba, Meituan, PDD, these kind of classic Chinese internet stocks, most of them are still in an earnings downgrade cycle, so that's the main thing why I'm not investing. And then after the earnings upgrade cycle, I'll go through the rest of the checklist to be comfortable or to be comfortable.
Yeah, and what about you, Nick? If I'm not mistaken, I think historically in the past you may have owned some of these Chinese companies, but at present times not. What the regulatory framework of investing in China?
Yeah, so we're a global manager, so it's important we don't have to invest in China. We've got the whole world to choose from. And about May last year, we sold all our Chinese stocks off the back of what Mary mentioned was the Ant IPO problem. We run sort of stop losses in our portfolio, and they'd fallen to a certain point, and we had to keep looking at them, trying to work out what we were missing. And what we worked out is that the regulatory regime had changed, and changed quite dramatically. And so we sold them all in May, and we thought that we were selling them near the lows, and they've all fallen another 50, 60% since then. So they're getting cheaper and cheaper and cheaper. I would agree with everything Mary said, and so I won't re-say it. But I will say one thing about China, which does worry me significantly, and I promise this conversation is going to get more bullish soon, because there's lots of stuff we like in the world.
We're going to get to that.
But China, honestly, looks like Russia did in 2005. I lived and worked as an oil and gas analyst in Europe for a long period of time. Russia was the most exciting place in the world at that time, in the early 2000s. It was opening up, the oligarchs were having a good time, there were these great oil companies like Yukos and others, and suddenly they just got too big for their boots. These oligarchs got too big, Putin cracked down on them. Everyone thought these companies would come back, they didn't. They went all the way to zero. And everyone thought Russia would be a buy again, and it wasn't. And I don't say this is going to happen in China, but I worry about it. I really do, because it's a wonderful country. I've been there many times. I now can't even go. I'm not sure my kids will even get to go. And I think it's very, very sad what's going on. And so from our point of view, there's certain levels where it doesn't matter how cheap it gets, because you don't trust the regulatory regime, you don't trust the earnings of the companies, you don't trust the ESG in particular, you don't trust the governance. And China's unfortunately reached that point for us. And only because we don't have to invest there. You know, I can go buy India, I can buy Brazil. There are great countries there, great companies with, you know, quite frankly, 2 systems of parliament, and quite frankly, a court that you can appeal to. I'll give you a simple example as someone who, you know, has owned Facebook in the past, and everyone might hate Facebook, okay? You might hate it, and I know lots of people do, and we don't own it today, it's okay. But if the government tried to do something to Facebook, you know, Facebook can appeal to the Supreme Court, and it can win, and it's done it lots of times. Something happens to Alibaba in China, the regulator says you've done this, they pay the fine within 6, they get investigated, they get fined, they pay the fine within 6 weeks, and then thank the regulator for fining them. And so from that point of view, there is no alternative, and so your shareholder capital, where is it safer, in Facebook or in Alibaba? They're both on the same multiple today, by the way. And it's probably safer in Facebook. And that's just a simple way of looking at it. That's how we feel today. I would love that to change. I really would. Maybe it'll change this week. But it hasn't changed since we sold, and I can't see it changing anytime soon.
Not sure it's going to happen this week, but...
Well, it could. The plenum's on at the moment.
Yeah,
you never know.
Yeah.
If you're interested, the plenum's on at the moment. It comes once every 5 years, okay? And at the end of this week, they're going to walk out in order. And whoever walks out in front is the leader of China for the next 5 years, okay? And it's a bit like the Pope thing going on, you know? They flash the smoke out the roof, etc. So you can read a 26-page dissertation as to which order they walk out in and what that means for the equity market, or you could just leave it alone. And for our point of view, we're just going to leave it alone. But it'll be interesting to see what order they walk out in on Friday, I think it is, in the Mary? Yeah, it's Friday. Thank you.
Circling back to the domestic space, Jack, we've spoken about interest rates and how they will impact the Australian consumer. It's interesting, there was some spending data to pick up on Nick's point before around the Australian household spending 20% more than 12 months ago. So we are still spending. So I guess the question is, what are the sectors that you're worried about and concerned about with Australian consumers spending less? So which ones are you avoiding and which ones do you think are attractive? And you're sort of trying to predict the future because you're not going to see this until the next.
That's right.
Yeah.
So, I mean, it's quite interesting because the stocks obviously are pricing something in, and you've seen obviously travel come back strongly, but I think travel, you know, 1 year out, 6 months from now, with the cost of flights and mortgages ratcheting up, you know, that could come under pressure, and they've been trading, you know, relatively strongly. You know, apparel, you know, how many pairs of, you know, running shorts do you need? I think we've kind of all done that. You know, Harvey Norman, discretionary retailers, sort of the obvious ones, I would say, Patrick. Yeah.
So in that micro-cap space, where we've got this issue around the consumer spending less and trying to predict, in that micro-cap space, is it harder to pick the stocks that you should be avoiding? Sort of in that big cap space, you can sort of line stocks against each other in an Australian context or a global context, but where you're dealing with these very unique companies, how do you find that?
Yeah, well, our micro-cap fund, like you guys probably wouldn't know, you know, 5 or 10% of the names in there. They're not well researched, they're not big companies by definition. You know, we find these companies ourselves, do the research ourselves. We don't really rely on stockbrokers to publish notes on them. So there are specific stocks and industries which are more immune from the tougher economic environment that we're in. You know, the education space is a good one. They obviously had a very tough time through COVID. They're relying on overseas students and domestic students. A company that we invest in, you know, is kind of coming out of COVID, so there's tailwinds there as students come back to Australia. And, you know, lower currency for Australia makes, of course, cheaper, you know, in their domicile countries. So there are these niche little pockets of stocks and industries that we like. So we're still seeing opportunities.
We'll have to turn this bullish now, Paul.
Yeah, I'm going to get there, but I'm going to ask, actually, Jack runs a micro-cap fund, and the 12-month return in a very negative market for micro-caps is actually positive, which is a phenomenal result. I guess what I wanted to ask you, Jack, you've seen parts of the market in the micro-cap sector significantly re-rate. We've seen a significant fall in that part of the market. You're a quintessential stock picker. Are you licking your lips? Do you see opportunities?
Look, as I said at the beginning, the market is 6 months ahead of us in terms of what it's pricing in. So those companies which can put out more resilient numbers than there's been forecast are going to go up, no doubt. There's absolutely no doubt about it. And then often everything gets bundled up together, inflation, sell all stocks. But within that, the old baby thrown up the bathwater analogy, is very much true. Sometimes you have, forced sellers, and you can take advantage of, a general panic that might not be specific. We talk to our companies we invest in on a regular basis, every 2 or 3 months. So often we know how they're tracking. And in micro caps, of course, the stocks are underlying a little bit of liquid in the screen. You can get stocks ticked down or not much volume, but then maybe there is a seller. So we know which ones are trading okay, which ones are slightly more immune, and they're the ones we're looking to buy on any selling.
Righto. So I'm going to start with Mary and we're going to work down. I don't think anybody sick of the bear market so far. I know,
Yes.
I know I am. Righto. We want to be in a bull market, Mary, going forward. So what are you looking for as the catalysts going forward for us to return to a bull market?
Okay, I would say inflation peaking and that earnings cycle turning around. Those would be the two main things. I guess the other thing I'll say though, to bottom tick a market is very, very difficult. So to say these are the two things on my checklist, as soon as those things happen, I'm plowing into the market. Back to the point I made at the beginning, we always run a diversified portfolio, and we don't make big bets like I'm going to 50% cash or putting 100% in the US or 50% in China or something like that. Running a diversified portfolio so you can perform well in bear markets and in bull markets, and then just changing things on the margin so that you can outperform even more when the market changes. That's sort of our strategy. Because market timing is very, very difficult. So I mentioned before about the best research ideas. A lot of, from my perspective, the big tech companies in the US and some of the internet companies, those are definitely on the best research ideas list. Some of the big consumer companies in the US, we've all mentioned that the markets get ahead of themselves. These shoot first and ask questions later have happened with some of the US tech companies. And then lastly, Europe. As I mentioned before, we're not invested in Europe right now because people are worried about Europe, particularly worried going into the winter time that the gas is going to get cut off from Russia, and a lot of the industrials or anything that's manufactured in Europe just isn't going to be able to be made. So those stocks, Mercedes is a good example. Mercedes is trading at 5 times PE. And if you think of like Mercedes, the brand, there is more than 5 multiple points just in Mercedes. So some of those kind of stocks are what I'm looking at and what I'm really excited about for the future. And
what about you, Jack? What are the catalysts you're looking for?
Yeah, I mean, we're just looking similar to Mary, but on a more domestic front, just sort of a tailing off of the inflationary pressures. I think, the good news is everyone has a job who wants a job.
Yep.
I think the consumer will become more confident once they feel more comfort in their house price. They have that as a tailwind, the wealth effect. Everyone knows if your house goes up, you feel like you've got money in your pocket. That's probably, come off at the moment, but I think the inflation will lead to steady interest rates, which gives everyone a little bit more confidence to go out there. I mean, Australia is very lucky. We have sort of food, energy. So in many ways, everyone's got a job. We're a fair way from some of the nasty stuff in Europe. So that's a positive. So and the market's pricing in another 6 months of uncertainty. So as that uncertainty ends, you'll see the stock market rally.
Yeah, and $1 million question for you, Nick, because you are holding some cash. So I guess this is the question you get asked the most, right?
Yeah, we do.
What are you looking for to put that money back in the market?
The joke I say internally, which I shouldn't say, is when everyone stops asking me the question. So you just asked me.
Yeah, I did, so it's not yet.
There's three things we're looking for. Look, interest rates just have to peak. You want just some comfort that the rates have peaked, so that's what they're calling about a pivot or a pause. We haven't managed to get that all year, but it has to be close. Rates at 4% are doing the work they need to do, so I think that one's really close. So peak in interest rates, peak in inflation, it's literally in the next month or two, personally. Second thing is you need the earnings estimates to rebase, so we spent a lot of time talking about that. That's going to take a little bit longer. purely because of those negative jaws that Jack talked about. They take a little while to play through the market. So that's the second thing you need. And the third I'd just tell you is just time. I've been through 5 bear markets. This is a bear market. I know it's not in Australia, by the way, but it is overseas. Your average bear market goes for 13 months. It falls roughly 30%, sometimes a bit more. And so sometimes it just pays to be a little bit patient, because this is the time where mistakes happen, like we saw in the UK last month. So those are the 3 things we're looking for. And the last and most important thing, and I'd agree with Mary, we don't mind if we miss the bottom. The bottom is, your average bull market lasts 64 months, okay? So you can miss the bottom and still have long periods of positive returns. The goal of our fund, our absolute return fund, is to make you 10% per annum after all fees and expenses on a 3 to 5 year view. And it's done that for 16 years. And it's still doing that, even though we're at the bottom of our 3rd bear market since we started. So the big mistake from here is to lose the next 20%. Just be a little bit patient. If you miss the first 5, it's fine. Because the bull market, when we get to the end of this, is going to be great. And maybe I'll just spend 2 seconds on this, because I think this has been way too bearish so far.
Go.
Look, the really exciting thing that's going to happen here, and I think everyone in this room should be excited, is think about the world you get to at the end of this, okay? At the end of this, inflation will be under control. Earnings will be rebased. This will blow you away. Governments will not be able to spend prolifically on anything they want to, because interest rates are going to be higher. And then fourthly, all speculation will be taken out of the market. And so this will just be a wonderful opportunity. This is going to set us up for what I think will be hopefully, a 5 to 10 year bull market. I just think it's a little bit naive to think you're going to get there within the space of 6 to 9 months, considering the excesses we had the decade before. And so if you're just a little bit patient here and just a little bit disciplined, you'll get through this fine, and I'm sure the guys here are going to help you. But ultimately, it's going to be a great opportunity, and one that I'm personally very, very excited about.
What about Mary, Jack? Share similar views?
Mary, after you.
Yeah, I agree. Taking a 5 or 10 year view, there are lots of amazing opportunities in the market. And I think the flip side of that coin is, if you think back to the way that fund managers felt at the end of 2021, and all the stocks that you love were just way too expensive. And so we were trimming stocks that we love, not because we didn't like them, but because, should like a semiconductor company like NVIDIA be trading on 65 times PE? No way. And obviously that stock is like down now 75% from its highs. So I agree with Nick. The long term is very, very exciting. One thing I do think we need to discuss, because we've spent a lot of time talking about inflation and interest rates, but is the impact of the US dollar. Because if there was something else on my checklist, I'd want to see the dollar peaking. The US dollar, because of geopolitical factors and because of interest rate differentials and a lot of factors, is very, very strong. And so that's causing problems for a lot of companies. We invest in big multinational companies. If you're a US-based company, you have 50% of your sales offshore, and the DXY, the dollar index, has risen 15-20%. That's just knocked 7 to 10% off your earnings right there. So from an earnings perspective, I'd really like to see the dollar peaking. And also from a geographical asset allocation perspective, emerging markets and non-US companies, like emerging markets generally do very bad in a rising dollar environment. So that means a lot of those, even despite all the things that we've talked about before, just from a currency perspective, you don't necessarily want to be in those. So I think the future looks very bright. There's still some muddy waters at the bottom, and looking forward to the next 5 to 10 years.
It's always interesting. I find when we're in bad times, we think those bad times are going to continue forever. But when we're in good times, we think those good times are going to continue forever. It's always sometimes better to be an optimist when everyone else is a pessimist, and vice versa.
And Patrick, Jack, sorry, can I just...
Oh, yes. Okay, just to follow on, I think patience, that's probably the thing. One of my colleagues, when I first joined Perpetual, said the market's a mechanism that takes money away from the impatient and gives it to the patient. The way we invest in profitable companies with little or no debt allows us to be patient. Certainly, we're probably nearer the bottom than the top, and a little bit of patience, well rewarded.
So I'm going to rattle off some terms here, and they're good terms: responsible investing, sustainable investing, ESG, impact investing, climate change. They've all become very mainstream. Can you each give us a stock that picks up on these trends and why you like it? I am going to start with Nick because of the climate sleeve and the climate change fund, which I think is a fascinating thematic. Nick's actually said that this is going to be a bigger investment theme than the internet, so he's got a lot to to talk it up
Potentially
to?
bigger.
Potentially.
Yeah, look, I mean, so from our point of view, every boardroom in Australia right now is sitting down trying to have a conversation about ESG. Within that, they're probably setting a net carbon neutral target. That net carbon neutral target means they're going to spend a bunch of money trying to get to net carbon neutral. BHP's doing it. There's a 165-page sustainability report that's audited by EY that you can go through that shows how they're going to get there. So they're going to have to make the trucks electric, they're going to have to make the building 6-star energy efficient, they're going to have to buy renewable energy. So our climate fund is not an ESG product. It's not meant to be. We do responsible investing across all our funds, but our climate product is really just a thematic strategy to invest in the companies that will enable this decarbonisation. We think it's going to cost anywhere between $50 and $100 trillion to decarbonise the planet. It's going to take about 30 years. And so that's $50 to $100 trillion in revenue to the companies that can help make you do it. And so from our point of view, our job is to go find those companies, just follow the money, because that money will equal earnings, and earnings growth, as Mary pointed out a couple of times, equals share price growth. And that's what we're all trying to do here. The one company I would give you is the energy transition is just that, it's a transition. So what we find is lots of people are throwing out companies that they don't fit their transition agenda. And so from our point of view, I would point to Constellation Energy in the United States. It's the largest nuclear generator in the United States. Nuclear energy, whether you like it or not, has a very important role to play here in how we decarbonise. If you control the nuclear fleet in the US, that's a very valuable asset. Why? Because you can't build where's the best place to build a new nuclear plant? Next to a current one. You can't build one anywhere else. That renewable power is worth money because you can use it to make hydrogen. Hydrogen needs to be made by renewable power. That allows you to upgrade the value of that fleet. Secondly, they're getting subsidies from the government to keep them open. And the last thing, which I think is super amazing, is Microsoft, to hit their net zero target, has to buy renewable power. There is a shortage of renewable power, so you actually pay a premium for renewable power as you do for regular power, even though it's a commodity. And so Constellation would be the one we point to. It's one of our better performing stocks this year, and it's just a great energy transition idea, of which there are lots of them, by the way.
Hello. We've got a phone call going on here. We'll just pause for a moment.
The watch.
Yeah,
it always
yeah.
gets you the watch.
You didn't tell people to turn off their watches, Paul.
Yeah. Oh, yeah, that's right.
You did
It's
say
the
mobile
iWatch. There we go.
phones.
Keep going with that.
Yeah, that's okay. Jack, I know a lot harder in your space.
Yeah, I think as a value investor, there's more an anecdote. I think I'd point to my small cap fund. The best performing best performing stock we've had this year is Whitehaven Coal. And it was earning its market cap and cash flow in 1 year. The unintended consequences of rushing through renewable energies too quickly and then shocks overseas in Russia, resulted in extraordinarily high coal prices. That's a company that's done very well for us. But in the micro cap space, we recently invested in a company called LGI Industries. It's a really interesting company. We sort of took it at IPO. It builds gas, biofuel gas in landfills. So it brings together renewables, environment, and energy together, and then they take advantage of any biodegradable organic mass they can actually turn to gas. Electricity companies can buy this energy off them, then they get credits as well, carbon credits. So that would be a good example of a company that sort of fits our style that we've invested in, that's benefiting from those tailwinds.
Mary, ESG is one of the processes you go through. I know you guys are signatories to the UN Principles of Responsible Investing. Can you talk us through a stock that you like in this space?
Yes, I can. First, if I can just take a step back, you mentioned a lot of terms in the
Yes.
initial question.
They're all the same, aren't they?
Yeah, no, they're actually totally different. So I think, when I'm talking to investors, I think one of the biggest things out there is that people don't know the difference. And so as a fund manager, one of the things that Alphinity is really, really strict on is making sure that what's on the outside of the tin, so we have a sustainable fund, and what does this mean is what's in the tin. And when people are unclear about what the different terms mean, it can be quite confusing. So if I can take 2 seconds, like within all those terms, the Responsible Association for Investors it's called RIA, in Australia actually has a spectrum. And on one side of the spectrum, we just have normal investing, don't care about ESG or anything. That's what we had, for decades before. And then you have sort of responsible investing that screens things out. So these are like sin stocks. We don't want alcohol, don't want gaming, don't what you don't want. And then you sort of move on to things that have ESG integration. We define ESG as operational risk. So this is not whether like a thematic, whether you're investing in climate change or whether you're investing in a plastic recycler or something like that. This is operational risk. And then we define sustainability in a very broad way. So we define it as companies where their activities align with the UN Sustainable Development Goals. You guys have maybe all heard of them. There's 17 goals that are ratified by the UN and most other countries in the world. And they include both social goals like no poverty, no hunger, good health, education, etc., and environmental goals like climate change, clean water, access to efficient energy. And so by defining sustainability in this broad way, and that is the kind of companies that we invest in our sustainable fund, it gives you a lot of options in terms of portfolio construction. And I think this is where there's been a lot of disappointment in the sustainable and climate change and ESG investing space, is that the way that people define the universe is not enough to create a diversified portfolio and therefore deliver returns over time. So we have a very broad view of sustainability. It's UN's Sustainable Development Goals. And in that context, I struggled a lot about, because there's lots of amazing sustainable companies out there. To get back to our point about being too bullish or too bearish, if you want to be bullish about something, it's the fact that the world is shifting towards sustainability. I actually spoke at something on the weekend. It was like for millennials. And if you look at the intergenerational transfer of wealth that's happening for over the next 50 years, there's a huge intergenerational transfer of wealth to a generation that is absolutely passionate about sustainability. And so in that context, the stock that I'm going to say is Tesla. And it's very it's very controversial. I'm sure 50 people will come up to me after and want to talk about Elon Musk. But when you're looking at solutions for the future, obviously in climate change, emissions, 30-40% of the world's emissions come from transportation. And that is the one aspect of climate change, or one of them, where we know what the solution is. And transition to EVs is that solution. And Tesla is the leader in the world in terms of leading that transition. So Tesla is a stock that I think is one for the future and one that's sustainable.
It's interesting you say about those terms, because I think I merged the UN, the two terms there, the UN with the other one, but that's okay. On all those things you spoke about, Mary, greenwashing, which is, do you just explain that? And you must come across a lot of it now, and that is certainly a challenge when picking stocks, isn't it?
Yeah, so greenwashing has come to the fore in Australia because ASIC has come out with some guidelines, and they're going after both companies and funds that greenwash. So greenwash is you say I'm environmentally sustainable, or I'm investing in climate change, or I'm doing this, and then you're actually not. And from our perspective, there's two kinds of greenwashing to be aware of. One is that you invest in a company that says I'm doing all these great things for the environment, and they're actually not. And then from your perspective, greenwashing can also be you're investing in a fund that says they're investing in these kind of companies or these kinds of thematics, and then they're actually not. So I'll give you an example on both sides. One is, so like H&M, for example. They came up with this H&M Conscious, it's fast fashion, and they said that they were using better materials, and they said that they were not putting them in landfills, et cetera, and that's come out they weren't doing that at all, and they're getting sued because they said they were transitioning to green, and they're not. So that's one example. And then there was a subsidiary of Deutsche Bank in Germany that said that they had all these ESG funds and all these sustainable funds, and then it actually wasn't, and their offices got raided, and they're in very big trouble. So for you, and luckily you have GFM to guide you through this whole sort of transition to sustainable investing, it's really important to, as I said before, know what's on the tin, because greenwashing is out there, and so you need people to guide you through what you're investing with respect to sustainability.
Well, I get to ask the first Tesla question in the room.
I want to know what Tesla to buy.
No, I'm first. No, I just want to ask. So we talk about ESG. Yep. The G being governance. From Tesla's perspective, they've got a very out there person that seems to be in charge of everything. Can you talk about how Tesla ticks the governance piece with Musk there?
Yeah. So if I can go back to the E, this is the thing about Tesla. This is the controversial part. Yep. Is that Tesla, from a sustainability perspective, the story is super obvious. You don't have to spend any time talking about it. E is also a very strong story, and S is a very strong story. So the only kind of question mark is over G. So the way that we look at it is, first of all, Tesla's a mega cap company now, and if you look at some of the other mega cap companies in the US, they're all the large US companies where you typically have a founding shareholder who still has a majority stake and or majority voting rights. So they are like strongly in control. We talked about Facebook before. Zuckerberg would be a good example. So Tesla, even though Musk is in the news all the time, he doesn't have a majority share and he doesn't have majority voting rights. So that's okay from a governance perspective. They have a board, generally well-functioning board, and there's, the board is doing things to control Musk. Secondly, there is a thematic that he's stepping away from the company. So he used to do all the quarterly conference calls, and now he's saying, I'm not. So we think that's a positive. The annoying part, to be totally frank, is this whole Twitter. The Twitter thing has just overtaken the media. And so, but that's part of my job, to be frank, is to say, this is what's real in terms of ESG, and this is noise. And because Musk is such a out there personality, and because he uses social media so effectively himself, and because he's a target, there's tons of noise, like tons and tons of noise. But if you cut through all that noise and look at the fundamentals of Tesla and where it's going, it's a sustainability story. I feel comfortable owning it.
Okay, I'm going to ask the audience to put their thinking caps on in a moment. We're going to ask the audience if there's any questions, and you very rarely get an opportunity. Not yet, Bogdan. We've got one more question, but you'll be first, okay? I love it. You'll be very first. He's very eager to go. But the last question that I want to ask is as follows. So, Nick, you're a global growth manager. Jack, you're a domestic value manager. Mary, I think you're style agnostic, right? So, Nick, I'm going to ask you philosophically why you're a global growth manager. I want to know, Jack, why you're a domestic value, and Mary, I want to know why you don't care.
Okay. I'll just take it back to the simple point is when I started my career, you could spend a lot of time trying to be over or underweight different sectors, trying to analyse economic data, etc. This was all, it's all useful work, but ultimately doesn't create that much value. From our point of view, companies that make more money every year, we generally find their share prices go up. That sustained earnings growth is normally valued more than cyclical earnings growth, and the market often misprices growth and its sustainability. So I could talk to you about so many different stocks that have managed to grow structurally over a long period of time that everybody in this room knows about. Visa, MasterCard, Google, and they've all managed to do it year in, year out, and their share prices ultimately follow their earnings. So from our point of view, I find it a very simple way to think about the world. What do I have to do? I have to find where there is structural growth. And if I can find that structural growth, then I can work way towards finding the structural winner. E-commerce is clearly a growing area. It leads you to Amazon. Internet advertising is a growing area. It leads you to Google. Smartphones are going to be great. It leads you to Apple. Electric cars, I agree, are going to be great. It leads you to Tesla. And so just find the structural change, find the big winner. Growth investing is what's worked for us for 16 years. It's the best way to get, what's the best way to get double-digit returns? Find double-digit earnings growth. That's how we do it, but I completely respect the way other people do it. They're just better than we are because they're buying companies they hate. And I don't know how they do it.
Righto, Jack.
I'm joking, Jack. I'm sure you like it.
This is Paul's question, by the way. I said they could end up fighting with each other, but that's okay.
No, we're not fighting at all. I have massive respect for the way other people do it.
Now the gloves are off. Look, there's two things for me as a value investor. One was sort of situational, just coming back from the UK as a 25-year-old and getting a job at Perpetual, which was a value manager, but it also kind of suits my personality. I'm probably not as optimistic as Nick. Probably a little bit, more cautious. Preserving capital. Sort of front of mind. Mums and dads like yourselves. Work very hard. And not losing money, I guess, is front of mind for us, and our process is very much built upon that. If you've got a profitable company that's got next to no debt, you can't really go bust. So, that preservation of capital thing really resonated with me. I'm a bit cynical, like some people, CEOs, about the new fandangled whiz bang. I kind of start rolling my eyes a little bit because, there's probably only 1 in 100 of them at best is going to be what it promises to be. So it was a bit of a marriage of, personality and situation to be a value investor. It's sort of all I know now, having been there forever, slightly institutionalised, but I've seen it work. I've seen the benefits of it, especially in choppy times, just not having the same drawdowns, that some some other styles, have to endure. It's not quite as sexy telling stories, about aluminium extruders and things of that nature, but the really that respect for that capital preservation and where it came from our clients, sort of really resonates with me and something we think about every day.
Righto, Mary, do we have a middle ground or not?
We do have a middle ground. So yes, Alphinity is style agnostic, and that is the main part of our process. Maybe I'll use an analogy to help you think about this. So as Paul knows, I have 2 kids who are very, very competitive sailors. They love sailing. And I was watching them sail one day and thought of this analogy. In sailing, like growth investors are saying, I'm sailing this way, no matter what. I'm going this way. And value investors are saying, I'm going this way, no matter which way the wind is blowing. And the Alphinity way is to say, our goal is to get to the top mark as fast as possible and to beat our benchmark. And sometimes, like in high growth markets, like you've seen over the last 20 years, it makes sense to go on a port tack. And sometimes, when you have a cyclical a change in the cycle, or when there's high inflation or whatever, it makes sense to go on another tack. And so our goal is not to anchor to one style of investing or the other. Our goal is to make it to the top mark first, to beat our benchmark, and to have very consistent outcomes for our clients. So that's the way that we do it.
Love it. We've had football analogies, we've had cricket analogies, and now we've had sailing analogies. So I hope it's working for
We're going to poll the audience for the best of the 3 responses now. No.
I'm not going to be that controversial. Okay, so we do have about 10 minutes for question and answer. We've already got one eager question over here. I think, is it Rebecca that's on the microphone? So we'll start with you, Bogdan, if you want to ask your first question.
Thank you, Paul. So my name is Bogdan Skomra. I've got a question to Mary and Nick. Both of you told us to be patient and wait 5 to 10 years. What if I don't have 5 to 10 years? Can you tell me what's your perspective in less than 5 years, from 0 to 5?
Yes, I would just make the answer that no, you definitely don't have to wait 5 to 10 years. To Jack's made the point a couple of times, markets are forward-looking, okay? So all the bad stuff we just told you about is at least halfway priced in already. The problem we're having is trying to work out, when it's fully priced in, because it's hard. How high is inflation going to go? How high are rates going to go, etc. At some point, my personal view, in the next 3 to 6 months, might even be less than that. Rates will have peaked. We'll know what inflation's going to do. Earnings will be rebased, and the market will just go back to doing what it always does, which is following great earnings stories. Companies that can grow earnings over time. Some of them would have got really cheap, and the value guys would have picked them up, and things will go back. These macroeconomic events that we're going through, in my opinion, last anywhere between 12 and 18 months. And then the equity market goes back to the same old equity market you're used to. That would be my answer to that question. But obviously I can't hand out personal advice, and I just want to be clear that the personal advisors are left and right here.
Mary?
Yeah, I agree with Nick. We're not saying you're going to have to wait 5 to 10 years before we hit the bottom, but saying that once things start to turn around, things start to turn around, I totally agree with Nick's comments before that the sort of environment that we'll be in afterwards is really, really exciting. And so, when I think about the work that we're doing at the office right now, we are doing more work about the exciting ideas that we want to be investing in 6 to 12 months than we are panicking about the ideas that we're in right now that maybe there's more downside. So it's hard to pick the bottom, but one's coming at some point, and then once we get into that nice market recovery, it's going to be a good time to invest.
Okay, do we have any other questions? Just raise your hand if you do. We just have one here from Eddie. Good save.
Yeah, I was just wondering, what do you think's going to happen to the global economy if China does invade Taiwan?
Okay, so the question was, wow, who are we going to hand this to? What is going to happen to the global economy if China invades Taiwan?
I think this is a rock, paper, scissors one, Paul. This is how we solve things in the office.
We are.
No, I can do it if you want. I get asked this all the time. Look, principally, it would be very bad. So the reason why Taiwan's important is because Taiwan is now Saudi Arabia of semiconductors. So 80% of the world's high-performance semiconductors are made in Taiwan. Nearly 50% of all semiconductors are made in Taiwan of any certain size. And so that's why the US has passed the CHIPS Act to make as many semiconductor factories as they can. That's why they're banning those chips to get to China. Why? Because chips are the new oil. And so the last thing I'd just say is that's why I don't think it will ever happen. because it's too important. It's too important to world peace, and that's why people are making lots of noise about it, if that makes sense. And so from our point of view, we think it's highly unlikely. If it did happen, it would obviously be very bad, because it would precipitate a geopolitical conflict that is much, much bigger than what's going on in Russia and Ukraine. And it would also have a direct economic impact, because we would not be able to source semiconductors. And semiconductors are the key to all productivity growth on the planet. And so from that point of view, it's a very important place. It's going to take about 10 years to diversify away from it. And in the meantime, expect the noise to continue.
Yeah. Can I just add something? So thank you for your question. I've been waiting for an opportunity to disagree with, with
cool.
Nick
Awesome. Here we go.
about China and the
I
Ukraine.
hope it doesn't happen.
So no,
Please
I
don't tell me it's gonna
I
happen.
agree with you that I don't think it's likely. That's definitely not the base case. And part of the reason is, and this is where my view differs with respect to Nick's in terms of China versus Russia. I don't think China is going to become the next Russia, because the mistake that Russia made, I also worked in Russia, in Moscow during the late 1990s, and Russia had a lot of oil and gas, but they didn't integrate into the global economy. And you've seen that very, very clearly when the Russia-Ukraine conflict happened. We went through all of the companies that we owned and we said, what's the exposure to Russia? And it was so sad. It was less than 2%. McDonald's, 2%. You know, like big global brands, 1.5%, Pepsi, 50 basis points of our sales. Russia never integrated into the global economy, so you can have a conflict, they cut them off, there's some issues in Europe, but really it's not integrated. China is completely different. The entire supply chain for many, many industries is based in China from a manufacturing perspective. 100% agree with Nick that semiconductors is like the crux of what everything in the world runs on right now, and it is China and Taiwan based. So the risk of anything happening there is just so great that I think that's why it's not going to happen. And the other thing is that, you know, you need to think about going, like President Xi, as we've mentioned before, this is his third term, how he's going to be remembered in the history books. It would be like worse than shooting yourself in the foot in terms of taking over Taiwan and driving the entire global economy into recession. Xi needs to worry about his own population and potentially political unrest. And I think that could be a very bad closing chapter for for him in the history books if it's reintegrating Taiwan and then sort of isolating China and driving the economy into the ground. So some things to think about, but I agree with Nick, unlikely going to happen, but yeah.
Do we have any other questions? Down the front here, just wait for the microphone if that's okay. It's coming, Rebecca. Thanks, John.
Thank you very much. My name's John Boston, and I'm concerned as to whether the Chinese factor is a bigger factor to domestic inflation than we think, and as to whether we should try and get a positive attachment to China or not. And my second question is, with the Australian dollar at about 63 cents, if we rush off and we buy global funds and the economy picks up, how much do we throw out the window and how much do we save with hedging?
Yeah, outstanding question, John. There are two questions in that. Jack, maybe from a domestic perspective. So the first question I think was largely about, you know, this relationship between China and Australia, or the intermingling of how important China is to Australia and how important Australia is to China and what that looks like. Is that at the forefront of your mind, or the companies that you're talking to?
It's an interesting dynamic. I mean, Australia's obviously biggest customer is China on the sort of iron ore, and energy side, and China has been what they say exporting deflation, meaning they're building things cheaper and cheaper, as you would have known, going to Bunnings over the last 10 years, for decades. So that potentially has rolled a little bit, but having some sort of independence, given how much of a big bully customer, I guess, they can be, as you've seen in wine and other industries, lobsters, crayfish, yes. There is that risk, and we are a very small country compared to China. So look, I think it's always there, but it is what it is. I think they have to mitigate some of those risks. They're having alternative suppliers for Australian companies manufacturing over there. The currency, like you say, is a headwind now for people procuring from China and from Asia. So it is a risk, but I think it's one that most people are aware of, and some of the companies have to either sort of get some alternative supply lines in just to avoid having that sort of one big customer or supplier that China is. But maybe I'll give the global hedging question.
Yeah, so that's a really good question. So Mary and Nick, I'm curious to understand how you guys handle currency, because really I think John's question was, with such a weak AUD against the USD, or what looks to be certainly not as good purchasing power, how do you handle that for Australian investors?
Yeah, it is a good question. We were actually discussing at our portfolio meeting just on Thursday. And so there's a number of different ways to do it. Some firms will have a hedged product and an unhedged product. We are generally unhedged, but at certain times, you know, if you get the currencies like wild moves in the currency, we can make the decision to hedge part of our product. So right now we are unhedged, but that's why we were discussing it. At certain levels of the USD or the AUD, is there a part of the portfolio that we want to hedge? The one thing I will say though is that we've all talked about how it's hard to bottom tick the market. It's even harder to bottom tick the currency. And so, you know, we feel that our expertise is in finding companies that have earnings leadership and being good stock pickers. Our expertise is not in making a big call in FX. So the decision to hedge or be unhedged would be one that we would not take lightly at all. But that's sort of from a portfolio construction perspective, and I'm sure that everybody at GFM can help you with that. But currencies are tricky, but there are options out there for global investments that will continue to perform in different currency environments.
Yeah, there's definitely diversification benefits of having Australian equities with unhedged international.
And Nick, I think the way you guys think about currency is interesting.
Yeah, so in our long-only products, we're the same as Mary. We run them unhedged broadly. In our absolute return product, unfortunately, the absolute return product is to make you 10% per annum on a 3 to 5 year view in Australian dollars. And so we have to take a view on the currency. And in this case, as the currency falls, we have already started to hedge it. So we have been hedging slowly towards 50% over recent times, and I'd expect that would continue as the currency goes lower. And so, again, our expertise is picking stocks. So coming back to the question before about getting double-digit returns, the best, you know, we're equity managers. You know, you can invest in fixed interest now and get a 4% yield, but in equities, the best way to get double-digit returns is to find that earnings growth. And the currency, if the currency is going to get in the way, we're going to hedge it, because we want that double-digit returns. That's what our clients are expecting. That's what we've done for 16 years, and that's, if the currency is going to fall low enough, we will hedge it. We have the ability to do that in our absolute return fund, and we do it all for you. Otherwise, you can invest in hedged products or unhedged products, but this is something we do actively for our clients.
Okay, we're getting towards the tail end. Do we have perhaps one more question from anybody? Excellent. Thanks, Chris. Just wait for the microphone.
Hi, yeah, just with all the negative talk around interest rates at the moment, it's probably a bit of a positive for me, because it means that I can actually get some interest back on my money. But I presume it's being eaten up by inflation. Nick talked about killing inflation. What does that mean? Like, does it mean zero inflation? And how far do interest rates have to go before you actually kill inflation?
It's a good, easy question, Chris. You far away, Nick.
Look, it's a great question. I think what we're saying, we want anchored inflation expectations. So we don't mean it has to be zero. Anchored inflation expectations somewhere between 2 and 3%. That's what we've had for 20 years. And some people in the room remember when we didn't have unanchored inflation expectations. We had interest rates at sort of 10, 12%. And that's why I told the story about the Garbos in Edinburgh, right? Because if you don't anchor inflation expectation, then it becomes a spiral. And so that's why they need to kill it. Your question about interest rates is 100% perfect. You know, that's the problem we're all having. We don't know how high they have to go to kill it, to get inflation expectations anchored again. We think it's somewhere around here. And then secondly, we don't know how big an economic slowdown it's going to create, and that's creating the uncertainty. But what I do know is, if you believe what they're saying, that they will do what they have to do to kill it or to re-anchor it, and they're prepared to put up with the recession to get it. And so, dare I say it, someone somewhere, I'm pretty sure, is going to repeat Paul Keating's famous line and say, this is the recession we had to have, to re-anchor inflation expectations. And look, it's a shame. Wish this didn't happen. I told you the story about COVID as to why it happened. It'd be better if COVID didn't happen as well. And none of this would have happened. We would be sitting here happily talking about a whole bunch of great company stories. But instead, we're not. We're talking about, COVID created this problem. Now we have to fix it. I suppose none of us thought we were going to get away with the whole thing scot-free, were we? Well, here in Melbourne we didn't, but that's unfortunately where we're at. And so your question's perfect. How high do rates have to go? The answer is we don't know. But at least from my point of view, it looks like they've done enough because I can already see the economy slowing and I can already see inflation slowing.
Okay, I think we've run out of time. Look, from Patrick's and my behalf and the rest of GFM, we are extremely grateful to Mary, Jack and Nick coming along and present. I thought they were absolutely fantastic, so if you can join me in thanking them. Yeah, to have a couple of the managers commit to come down to Melbourne on a Monday from Sydney to present to our clients, we're very grateful for.
Nick down in the Pean Highway as well.
Yeah, Nick did. But he would have come up to Sydney if we were in Sydney for sure. Just a couple of little housekeeping items before we finish. As I said before, you're going to get emailed the evaluation form. We'd appreciate your feedback on this type of conversational piece, or certainly running this style of presentation rather than up at the lectern. I've found having a panel and having the depth of experience that we've got with these guys to be particularly valuable. We welcome your feedback on that. There's no rush to hurry off. We're done now. It's 2:00, but we're going to be here. Nick and Mary and Jack will be here a little bit longer, so we'd love to come around still and say hello. But on behalf of the team at GFM, we really do appreciate your support coming along on a Monday. Hope you enjoyed lunch, and more importantly, we hope you enjoyed the presentation. So thank you.
All right. Well done. Thank you.